If you spend a considerable amount of time online, then you must have heard of terms like Bitcoin or Ethereum, maybe even something about the market being bullish or people being in the red. Well, if you're wondering what those terms mean, then you've most likely stumbled upon the market of cryptocurrency. Just like investing in stocks, there are also a few tips and tricks to make the most out of your crypto investments. That said, here are some efficient hacks to increase your crypto portfolio. If you like this video, then don't forget to give it a thumbs up and click that subscribe and notification bell to get future updates on new videos. Diversification. One of the most attractive features of investing in cryptocurrency is that your investment has the potential to explode in a matter of days, weeks, or even months. Having your initial investment multiply by 5 times or more in such a short span of time is a common occurrence in the crypto world, assuming of course you choose the right coin to invest in. The downside to that is just as it has the potential to explode in price, so does it have the potential to get reduced to half of the original price or even less. This just means that when you invest in crypto, you also have the potential of losing everything. To mitigate the loss, a lot of crypto traders choose to diversify their portfolio. As people who invest in stocks say, it's better not to have all your eggs in one basket. Let's pretend you were going to invest $100 in cryptocurrency. Instead of funneling the entire $100 into a single asset, what you do is you split it for 5 different coins, with each coin getting $20 from the original 100. In this way, should one of your coins experience a plunge in price, the other 4 that didn't wouldn't keep your portfolio afloat. What's better is if 1 or 2 of those coins actually increase in price, you can all the more prevent losses. Because let's face it, no matter how confident you are in your investment, there's no telling where the price would go. The question of how many coins you invest in and what proportion of your investment you allocate to each would depend entirely on your research, risk appetite, and the amount you're going to invest. You may also want to consider the type of cryptocurrencies you want to invest in. It could be payment coins, NFTs, DeFi, etc. Copy trading. If you're new to cryptocurrency, then it's probably safe to say that you've done a certain degree of research. One of the first things that crypto traders do when they find a potential profit is by looking into the coin. This involves seeing how many people are investing into it, what the coin would be used for, what are its plans, its current supply, basically anything that will make you think that it could produce a potential profit and that it's not a scam. The problem is, there's just so much cryptocurrencies out there, with hundreds being created every day. And more often than not, each of those coins would have websites telling you that it has the potential to moon. With an overwhelming amount of possible choices, how do you decide? Luckily, there's a feature in some platforms like Coinantics, 3 Commas, and eToro, where you can copy trade. What this essentially means is you can copy the trades made by a professional investor. Instead of looking into thousands of coins, what you can do is make a list of some credible and experienced traders and copy what they're doing. You then link your account to their trade moves so that whenever they sell or buy a specific asset, yours would automatically do the same. You can also choose what percentage of your portfolio to allow to be managed by the trader you choose. It sounds sort of lazy and irresponsible, but copying someone's strategy is a strategy that works in the crypto world. What's more is that you don't have to do that much. It's like making the experienced trader do your trading for you. DeFi staking. If you're the kind of investor who has the patience to wait for months or even years to gain profit, then this is the strategy for you. Staking is a method of locking up your current crypto assets on a platform of your choosing in order to get annual interest. So what difference does this have over the traditional deposit on a savings bank account? Well, the great thing about this is that instead of earning 1% annual interest or less, it's possible to earn 5 to 25% in crypto staking, possibly even higher. But before you actually go ahead and start staking, there are a few things that you need to know. The first thing is that once you lock your assets on a specific platform, you cannot withdraw the assets until the time specified for its release. So if you happen to hear a juicy tip about a crypto asset that's going to explode in price, you won't be able to use the assets that you've staked. That's why it's important to be absolutely sure and confident enough in the crypto asset that you're going to stake in. The second thing you have to know is that not all coins have a staking feature. Thus, you can't expect that every coin you're interested in holding for a long time you'd be able to stake. There are, however, some websites and articles which tell you the best coins out there that you can stake. An example of a staking asset would be ADA and IOTA. The third is that you need to do very diligent research on the particular platform you plan to stake your coins in. There have been multiple times wherein investors are scammed off their investment by questionable platforms. Hundreds of millions worth of dollars were reported to have been scammed off investors because of this. So for those planning to stake, always make sure you know where you're putting your money in. Hedge crypto. This is one for the more experienced traders out there. Just like diversification, this is a strategy aimed at minimizing potential losses from your investments. The strategy works by first making a trade that's in the direction you believe the market would go, while at the same time placing a second trade that's aimed in the opposite direction. This way, you'd be able to gain profits should the market go up, while also limiting losses in the event it doesn't go the way you expected it to. One of the most common means of hedging trades is by committing to either long or short in the futures market. Again, you need to be very particular of the prices you set in order to minimize the likelihood of liquidating your entire portfolio. Having said that, it's important to understand that this is a very risky strategy as well, which merits the argument that only experienced traders should take on this strategy. So if you're new and you still don't quite get this one, then that's okay. For now, you can stick to less risky strategies. What's most important is that you do your research in every asset you invest in and not get too emotional in trading, which means don't trade reactively. There are other strategies and tips that you can learn along the way.